Hi everyone, today I'm going to do a quick high-level valuation of Pinduoduo to see whether it is worth spending some serious time researching the company. Now there are so many companies out there to invest in and we can't do a deep dive into all of them, so I thought I would go through with you a relatively quick way to filter through all these ideas. Even though I will do this high-level analysis and it might look really attractive or unattractive, it doesn't mean it will be a good or bad investment. This is just a starting point to help us work out whether we should go further and investigate. So follow along to learn how to do this yourself, and we will have a target buy price by the end of this video. This is part art and part science, so remember that there are a lot of assumptions going on here. All right, let's start. Okay, to do the Pinduoduo stock valuation, I'm going to go through a 9-point checklist that I've created to help me do a high-level look, and then I'm just going to go through my opinion at the end. So the first step is we need to look at revenue growth. So revenue is obviously the money coming into the business from selling their products or services, and I want to see the business getting better. I go over to Morningstar, and I'm just looking here at revenue. It's in Chinese yuan, and from 2016 to 2020, it's gone from about 500 million to nearly 60 billion. So yes, we've got very, very strong revenue growth here. To even try to calculate the revenue growth here, it's probably kind of silly from such a low base, but the last couple of years, it's been growing at, well, it looks like, well, from 30 billion to 60 billion, from 13 to 30, that's a double each year. So that's significant growth. We're at least talking about 100% here at the moment for revenue growth. Now, the next thing I want to look at is the gross margins. So gross margins is revenue minus the costs of the product. So for example, an iPhone costs $1,000 to buy, but it costs Apple about $600 to make the phone. So the gross margin is the difference, which is $400 or in 40%. So if gross margins are growing, it means either the competitive advantage of the business is getting stronger, they can charge higher prices, or they're getting more efficient so they can reduce their costs. Both are really good to see. So the Pinduoduo gross margins are, I get a gross margin percentage here, and it was, well, for the first few years, it's really difficult for a company to understand their gross margins, but the last few years, it was in the 70, nearly 80% range, and now it's dropped back down to into the 60% range. That's pretty high still. Anything over 40% is pretty high. So I would say this is okay, but I would want to keep an eye on this to make sure over the next few years, this isn't trending downwards too much. So we're going to say it's okay. It's probably a tick, but keep an eye on it. Then we go look at return on invested capital. So the ROIC is a percentage that tells us how well management are investing money back into the business. Now, this number is a percentage return on the investments made by the company in the previous 12 months. So it's pretty easy to find this one. What I'm going to do is I'm going down into the profitability ratios for the business, and we look at return on invested capital percentage, and they're all being negative. Even though they were like 100% negative, they've started getting closer to zero. This is still a negative because the investments that they're making aren't yielding strong returns to the bottom line of the business. So we've got to get that a big no here. So that's a red flag. Now we're going to look at the debt levels and specifically what's called the current ratio. We want this over a 1.5. Now this means that debt isn't a big deal in the short term if it's above this 1.5 number. So debt is the number one reason why a business gets into trouble, and debt can be good to fuel growth, but we just want it to be manageable. So if they have plenty of cash to cover their debts, well, it should be fine. In the latest quarter, it's saying it's 1.76. It has been above 1.5 for the last 3 years. So that's not a problem at all. We can give that a tick. Now we're going to take a look at the free cash flow. Now, free cash flow is operating cash minus capital expenditures. So essentially it is the cash coming in from running the business minus all the things needed to keep the business going and growing, like the maintenance on machines, updating software, and investing into future projects like new factories, new machines, new computers, things like that. Now, what is left over after these things is called free cash flow, and this is what is returned to us as shareholders. So it can be returned to us in lots of ways. through dividends and share buybacks and paying down debt. All of this stuff is good for us. So we want to see this free cash flow solid and growing, and having a healthy free cash flow makes it quite easy to calculate a fair value. Now, if we take a look at the free cash flow for Pinduoduo, well, we see it has been growing very rapidly over the last 5 years, similar to what we saw with the revenue as well. Now, before we go any further, I want to quickly talk about my brokerage accounts that I use and that I think are really important for especially new investors who don't quite know exactly where they're going to buy their shares and what platform to use. Now, there are things like Robinhood and Webull out there, but those companies haven't been around for very long. So they haven't built up some sort of reputation in the industry, and they haven't gone through any sort of financial difficulties yet. Interactive brokers, Saxo Bank, have been around for many decades. They've gone through financial crises before, so they're reputable and they're stable. Plus, Interactive brokers and Saxo Bank have access to international markets, and that's going to be really important, especially for a lot of things that I look at on my channel. We want access to Japan and Great Britain and Australia. If we're on these other platforms like Robinhood and stuff like that, we're not going to get access to those markets. Now, if you have done some research into these brokerage platforms and you do decide to go with Interactive Brokers or Saxo Bank, I do have links in my description which are affiliate links which do help my channel. For Interactive Brokers in particular, you will get $200 of free Interactive Brokers stock. Now we're going to take a look at the shares outstanding. So shares outstanding is just the amount of shares available for the general public. If this number is getting bigger, well, it means that we are getting diluted, and that's a bad thing. It means our ownership percentage is getting less and less, which decreases how valuable our shares are. So we want to see this stable, or better yet, we want to see it decreasing. So for Pinduoduo, the shares outstanding, it has been growing, but the last sort of 2019, 2020, the trailing 12 months, it has slowed significantly from the big jump from 2018 to 2019. That is still increasing, so that's not what we want to see. So we are getting diluted, and that's a bad thing. Now we're going to quickly take a look at the insider ownership. So we want the CEO or the founders to still be heavily invested. This means incentives of the people running the business are aligned with us as potential shareholders. So just imagine if your salary was, say, $1 million a year, but you actually had $20 million in shares of the company you're working for. Well, the share price is far more important than your salary. Therefore, you want the share price to improve just as much as the shareholders. So to find this information, we go over to a place called Simply Wall Street, and I scroll down to the section that says Top Shareholders. And we look at Zhang Huang, he's actually the founder of the company. He still has 35.5% ownership in the company. That is massive. Anything over about 5% is actually really strong. So 35% of the company is still his company. The next biggest holding I just want to show you is actually Tencent. So they own a little bit over 15% of Pinduoduo. Now, that's really interesting because so if you were wanting to invest in, say, Tencent, you actually get a piece of Pinduoduo with it. So that's something to keep in mind. Now I want to go see whether any super investors have invested in the company. See, I'm not that smart or experienced as the people who have made billions over multiple decades. If any of my favorite investors have invested in a company and I'm looking at it, well, that means that it has already passed their strict filters. They also have probably done extensive research and built up a lot of conviction in this idea. So it would be a massive tick of approval. So to check for this, I go to a place called Data Roma and I type in the symbol PDD for Pinduoduo. And the portfolio managers currently that hold Pinduoduo are Chase Coleman, who I'm not familiar with, but Li Lu of Himalaya Capital, I'm very familiar with. He is one of my favorite investors, and he's a very, very smart Chinese investor as well. He has a big stake in the company BYD, and he's actually, he invests Charlie Munger's, a lot of his net worth as well is tied up in Li Lu's fund. So look, this is a massive tick of approval, and this actually is the reason why I'm looking at Pinduoduo in the first place. Okay, last but definitely not least is the price. The price is what you pay, and value is what you get. So the price we pay is the most important thing by a lot, but we have to do it last because we need to understand those growth rates. Because we've had a look at revenue now, we've had a look at free cash flow and things like that, and got a feel for the growth rates. Now, even if it is a great company and we overpay for it, well, we will get a bad return on our investment. You wouldn't buy a new Ferrari for $20 million. It's a good car, but that's a bad price. The value of the car would be lucky to be $250,000. So price is critical. So That's what my intrinsic value calculator is going to help us with. And if you want a copy of the intrinsic value calculator I'm about to show you, it's free, it's in the description, and it'll just be an email that gets sent to you with this template. Okay, so what we're going to look at is we're going to estimate growth rates over the next 5 years and then slow it down for the next 5 years after that. So it had been growing at 100% per annum. We looked at the free cash flow and it had started to slow down already. So you've gone from 14 billion to 28 billion, and potentially the trailing 12 months is only going to be about 25 billion. So we've definitely seen some slowdown of growth here. I don't know what's going to happen. This company has been growing so quickly that maybe the growth has actually stopped. Maybe it grows at 100% again for the next 5 years. This is actually a really difficult company to make a guess on because of these strange growth rates. But look, let's go somewhere in the middle and say, I don't know, maybe 40% for the next 5 years. Like I said, it had been growing at 100%, maybe slowing that down to 40%. It's possible. And then maybe it goes down to just 10% after that. You might think it's still going to grow at 100%. You might think it's going to be 0%. You might think it's going to be negative. Look, play around with these numbers anyway. Now, to get this discount rate or my return on investment goal, now I'm actually going for something around 20, maybe 26%. That would be what I want to get as my return on investment. But this is where I also incorporate what I call a margin of safety. So what I'm going to do is actually go for a 30% discount rate. Now, if I use 30% and I get anywhere near 30%, well, that's fantastic. But the chances are these growth rates are going to be wrong. Maybe I'm wrong on the high side, so therefore I might only get 20% return on my money. That's why I'm going for such a high discount rate here. So the multiple I could sell it for after these 10 years. Now, if it is growing at these rates, say it's growing at 10%, I'm probably only going to be able to sell it for 20 times free cash flow after 10 years. That's pretty fair. Now, the next thing we're going to look at is the operating cash flow minus maintenance capex. Or in other words, this is free cash flow. Sometimes finding this maintenance capex number is really difficult. It's just more advanced. But if you don't want to go off and try to find this maintenance capex, just use free cash flow. So the free cash flow number was about 25 billion Chinese yuan. So I don't know what that is in 25 billion is 3.86 in USD. So 3.86, that's what the free cash flow is at the moment. Okay, shares outstanding. So let's say, I don't know, 1.3, because that'll give us the growth the growth in the shares outstanding over the next few years. That's probably not too bad. Now the total cash and total debt. So what I do is I go to Yahoo Finance and I go down to the balance sheet metrics and look at the total cash number. This is in Chinese yuan, remember? So I've got to turn 83 billion into USD, which is 12.8. Okay, good, 12.8. And then I've got to do the same with the debt. And the debt was, well, it's 12.8. So I've got to turn that into USD. And it's about 2. Okay, cool. So the price that I want to buy it at based on these metrics is around about, let's call that $60 a share. So if I go and have a look at the current price, it's $100 a share at the moment. So it's still too high in my opinion, but if I fiddle around with these growth rates, let's say I'm going to be a little bit more aggressive and let's say it actually grows at 50% for the next 5 years, which would be exceptional. And then maybe instead of it slowing all the way down to 10%, maybe it slows down just to 25% per year. Now in that scenario with these higher growth rates, well, we've actually got a buy price now at $108, which is below what it currently is today. So these growth rates are really important. I think this is just way, way too aggressive, and I would never count on 50% and then 25% growth for the next 10 years. This would turn it into probably one of the most dominant companies in the world, considering its market cap is already $130 billion. So look, I don't see that being possible. Look, I said 40% before. I'm actually going to put it down to 30 and 15. That feels a little bit more comfortable for me. So look, around that $50, $60 range is probably where I would get pretty interested. At the moment, it's too high, so I can just happily let this one go. Okay, so my opinion after going through my 9 points is revenue's growing really strong. Gross margins are solid, maybe something we have to keep an eye on in the future though. Return on invested capital is poor, but look, it's a growing company. Maybe this changes in the future and they become a lot more profitable. Not quite sure, something that I would say is a negative at the moment. Their debt levels are fine. Their free cash flow is stable at the moment, but it had been growing really well, and then it looks like the trailing 12 months has actually declined a little. So again, something to keep an eye on. We've got the shares outstanding, we are getting diluted. The inside ownership is really strong, and Tencent own a stake of this company as well, which is very interesting. But a massive positive is that Li Lu, probably one of my favorite investors, is invested in this company. So that's a big tick of approval. But when we looked at price versus its value, I just think the price is a little bit high compared to its value at the moment. At the current price of $100, I can't see that being good value considering, look, my growth rates were having to be very aggressive just to get anywhere near that $100 range. So look, for me, I'm not ready to buy this one yet, but it's something that I'm going to keep an eye on my watch list, mostly because of Li Lu, and maybe in the next few years things change in the business and the growth rates are still at 100% or something crazy like that, and I will wait for a price that I'm willing to pay. And if you have a company you'd like me to do a quick valuation just like I did today with Pinduoduo, leave it in the comments below, give the video a like before you leave, and I will see you next time.